Hello, everyone, and welcome to our State of the Market presentation. You're in for a real treat this evening. Let's dive in, shall we? What I will first start with is I will start with our disclosures. Triumph Capital Management is a registered investment advisor with the SEC. We are located in Denver, Colorado. That is where our home office is. Tonight's presentation is for educational purposes. I will be sharing a lot of information, and a lot of it is designed to be educational for you. You should not take this information as recommendations or somehow a recommendation to purchase or sell any type of securities. You should seek professional advice from your own financial advisor or other advisors about your investing needs, so on and so forth. Investments carry risk. In addition, I'll be making some forward looking statements tonight about 2005 and where we see the market heading. Again, these are forward-looking statements. They may be my recommendations, so on and so forth. But again, this presentation is for educational purposes only. Please seek professional advice. Let's keep working here. A little bit about myself. My name is Derek Eichenwald. I have the distinct pleasure of serving as Triumph Capital Management's CEO and Senior Investment Executive. If you hear an accent, I am originally from Boston, Massachusetts. I've been living in Denver since 1999. At this point, I have been in Denver longer, I believe, than I lived in Massachusetts. I've been doing this for 23 years this June, and let's jump in. First things first, we have a ton of people inside of the presentation tonight. If you have a question inside of your webinar box, there is a square that has a question mark. If you click on that, you can type your question. I will try to field them as we go through the presentation this evening. Chances are, if you have a question, someone else is thinking it. So please ask questions when you have them. I will get you out of here within the hour as a heads up. If you have questions that you would like answered offline at the end of the presentation, you will see our phone number, our email address, so on and so forth. Please feel free to give us a call or shoot us an email. All right, let's start with the agenda. First thing we'll cover is we'll talk about how did markets perform through 2024. We'll talk about what drove market performance through 2024. We'll talk about where we are today. And lastly, our forecast for 2025. What do we see on the horizon, so on and so forth. Okay, so stock performance in 2024. As we jump into this, I think it's always important to look at where you were, where you are, and where you're going. Where you were, where you are, and where you're going. So let's quickly look at a graph of the S&P 500 from 1980 until basically current date. This chart is as of January 16th. The date of this recording is January 21st. So we're missing 2 trading days inside of there, but no big deal. What this graph is, for those of you who join these webinars regularly, are now very familiar with it. For those of you who don't, let me unpack it. The gray bars are showing you what the S&P 500 did as far as performance is concerned in any given year from 1980 until January 16, 2005, or current date. Those gray bars, when they're to the upside, obviously that's showing you the upside of the S&P 500 in any year. And the gray bars to the downside are showing you years in which the S&P was down. What I really want to draw your attention to are the red dots. The red dots are showing you at one time during the course of that year what the S&P 500 was down. For instance, let's pick out 1980 just because it is easy on the eye. 1980 was a fabulous year for the S&P 500. The S&P 500, as you can see, was up 26%. However, at one point during the year, it was down 17. The point that I'm trying to make is that these red dots are not the exception to the rule. They are the rule. They are the rule in any given year, as you can see on that chart. At one point, the market was down, and in many years, it was down an ugly percentage just to end the year up very nicely, as it did in 1980 when it was down at one point 17%. Yet, come the end of the year, it ended up 26. Um, Although this chart is as of January 16th, and you can see here it says the S&P 500 is up 1% for the year. You'll also notice that we show it was down at one point over the last 21 days, 2%. So that you know, as of the close of business today, January 21st, 2025, the S&P 500 is now up 1.96. The S&P 500 as of January 21st, 2025 is now up 1.96. It is also fair to mention that you cannot invest directly inside of the S&P 500. It is an unmanaged index of securities. You can get very close to investing in the S&P 500, but nobody can invest directly into the S&P 500. I'm going to go ahead and I'm going to flip that chart. And now I am showing you the Bloomberg US Aggregate Bond Index. And this time I'm going all the way back to 1976. The graph data is the same. Gray bars to the up show you if the Bloomberg Aggregate Bond Index was up in any particular year. Gray bars to the downside show you if it was down in any particular year. And the red dots again are showing you during any year what the Bloomberg Aggregate Bond Index was down. Again, the red dots are the rule, not the exception to the rule. And looking at both of those charts, you probably noticed that you had an amazing amount of gray bars to the upside. And that would be correct. Markets over time do very well. So, how did stocks perform in 2024? Well, as many of you know who join these webinars regularly, at the beginning of every year, one thing that we show you is we show you what the pundits, if you will, forecasted the S&P 500 to do through 2024. As you can see on my screen here, you have a number of different predictions. You can see where the group averaged out at 4,817. At the same time, you can see where the S&P 500 actually ended at 5,881. For the year, for 2024, the S&P 500 posted a 23.31% gain. So the S&P 500, for all intents and purposes, was up 23.3%. 23.3%. One question you may have is you may think to yourself, hey, how come all of these Wall Street firms, pundits, talking heads, if you will, got the predictions so wrong? And there may be several reasons for this, but one reason was widespread concerns of a recession, earnings disappearing from companies, and kind of inflation concern, which would eat up wage growth, so on and so forth. I'm going to unpack that a bit more as we go through tonight's presentation. Another interesting tidbit of information. Although the S&P 500 posted a 23% gain, if you remove the Magnificent Seven include Apple, Microsoft, Google, Amazon, Facebook, also known as Meta, or Meta, also known as Facebook, Tesla, and Nvidia from the S&P 500, just those 7 stocks from the 500 stocks inside of the S&P 500, the net results during 2024 of the index would have resulted in about 12%. Isn't that crazy? 7 stocks shot so much of 2024's performance. Just an interesting side fact there. Let's keep working here. Okay. So, what drove market performance through 2024? What drove market performance? What caused the market to be up 23%? Well, we began the year, and at the beginning of the year, what we had CPI that had come all the way down. CPI is inflation, came all the way down from 9%, and we began the year with inflation, with an inflation read of 3.4. So inflation was heading in the right direction. Let me say this. The Federal Reserve has what is called the dual mandate. The dual mandate. The dual mandate is this. I will bring it up a few times in tonight's presentation, but the dual mandate is this. Unemployment, 4%. Inflation, 2%. Let me say it again. Unemployment, 4%. Inflation at 2%. So number one, you had inflation come down and we were, getting down from the 9% that we hit back in June of 2022. Okay, so we had steadily declining inflation, and that was nice for the market. Okay. And inflation continued to come down. By the time we got to July, 7 short months later, we had inflation all the way down to 2.9, very close to that Federal Reserve's mandate of 2%. What you'll also notice is you'll notice the headline that unemployment hit a 33-month high. That being said, unemployment prior to 2024 was well below the Federal Reserve's targeted rate of 4%. We were sitting in the threes. I'm going to show you some slides on that in a little bit. And so when it says a 33-month high, that was the intention of the Fed. That Fed wanted unemployment to go higher. So this was all looked at good. You had inflation coming down. You had inflation coming from June 2022 at about 9%, coming down to their target of 2%. And you had unemployment, which prior to 2024 was below 4%. Remember, the Fed wants it at 4%, going up and getting close to that Fed's 4% target rate. And you can see the market just steadily chugging along. When I say the market, I mean the S&P, chugging along through 2024. Then in September, you got the long awaited, yet anticipated Federal Reserve interest rate cut. The Federal Reserve interest rate cut. It was the first interest rate cut that we had received in 4 years. The federal funds rate was all the way up to 5.5%, and the Fed in September made a 50 basis point interest rate cut, taking the federal funds rate from 5.5 all the way down to 5%. And that really threw a lot of gas into the market, and it really accelerated things, so on and so forth. And why, I'll explain later. And then in November, tonight's discussion is definitely not a political discussion. But what I will say is one thing that the markets love is some level of certainty. In November, as all you know, we had presidential elections. The results of such elections came back very quickly, and they were very decisive. In other words, President Trump won the White House, and there was no shenanigans with it. And so that increased some level of certainty into the marketplace. 2024 was a wonderful type of year. We got that first interest rate cut. By the way, those September cuts were followed by a November cut on November 7th. The Federal Reserve again cut rates by 25 basis points, bringing the federal funds rate down to 4.75. And then they cut again another 25 basis points on December 18th, 2024. Now, next week, we have the Federal Reserve meeting, I believe the 28th and the 29th, and we'll get the FOMC, which is the Federal Reserve's interest rate decision. Will they cut again? Will they keep rates steady, or will they increase? I'm going to share my thoughts on that as we get closer to the end of the presentation, and I give you some forecasts for 2025. But let's keep working here. We're doing good. In 2024, earnings from companies, we had a resurgence. We had 5 consecutive quarters, as you can see here. So Q4 2023, followed by Q1, Q2, Q3, and getting in finally into Q4 of earnings growth. Now, let me explain. Earnings are referred to as the mother's milk of stock performance. They are the primary driver of company value, and ultimately, it's stock price. They drive that stock price over time. Okay, they drive that stock price over time. And as my slide shows, you had a bit of an earnings recession in 2023. You had 3 quarters of kind of negative earnings, and then we got into some nice earnings growth. Now, when I say they are the mother's milk of stock performance, let me explain why I say that. This is very important. When you look at companies today, first of all, what is the stock market? I ask people that all the time, and then they get a little nervous, and then they kind of don't know. Let me explain, first of all, what the stock market is. The stock market is an exit strategy for companies. What do I mean as an exit strategy? Well, pretend for a moment you and I own a company together. We bring in $1 million a year. We're not publicly traded, we're privately held. We have on average $900,000 a year of expenses. That's for our employees, our rent, our product, just our overheads. 900 grand. We're left with $100,000 bottom line revenue. We've been at this business for the last 25, 30 years. We want to sell. We may go out there, hire financial advisors, CPAs, business brokers, so on and so forth, and attorneys to figure out the sale of our business. At the end of the day, when you look at privately held companies, ones that don't trade on any exchange, they sell for 3 to 5 times earnings. 3 to 5 times earnings. In other words, somebody would write a check for $300,000 to $500,000 for the right to ring our register for the next 30 years. 3 to 5 times earnings. Okay. Now, just pretend we're growing earnings. So instead of having bottom line revenue of 100 grand, let's pretend we have it at 200 grand. And again, if we now went to go sell, okay, and on average 3 to 5, instead of getting 300 to 500,000, we got 600 to $1 million. So bottom line revenue, and that's what I'm showing you here on this slide, is really what drives stock performance. Now, when I said the stock market is an exit strategy, let me explain. So again, pretend we got that boutique business. We make 1,900 grand of expenses. We're left with 100,000. Well, if we went to go sell our business, there's probably plenty of buyers at the 300 to $500,000 level. Plenty of places that will write that check to buy our business. If they were double, there's still plenty of places that would write that check to buy our business. However, now imagine that our bottom line revenue is $1 billion. Okay, $1 billion. We're still not publicly traded. Who's going to write a check for 3 billion to 500 billion? There's very few people, very few private equity firms, or very few publicly traded companies that may be willing to buy our business. And so when I say the stock market is an exit strategy, instead of perhaps selling our business to a buyer, someone that can write the check, we might go out there and sell all of our business or a portion of our business to investors. The world can invest inside of it. It's simply an exit strategy. Now, here's the other thing that I want to share with you. What I have on my screen right now is Q3 earnings 2024 at 5.8. You'll notice at the 5.8, it was lower than the previous quarter, but still looked very nice. And I want to share with you that at the end of every quarter, so we ended Q4 2024, right? Just 21 days ago. About 2 weeks after the end of the quarter, we go into something that is referred to as earnings season. Earnings season is a wonderful time, and we entered earnings season last week. Okay. The way things are shaping up, the expected earnings growth for Q4 2024 is 12.5%, as you can see on my slide. 12.5%. We're going to talk about why that is. We're going to talk about where that goes, so on and so forth. What I also want to let you know is we kicked off earnings season with all 6 major banks reporting, and all 6 major banks reporting better than expected results on their bottom line revenue. What major 6 banks? JP Morgan, Citigroup, Wells Fargo, Goldman Sachs, Bank of America, Morgan Stanley. And literally, they all crushed it on their bottom line revenue. That's been one reason why you've seen the market do extremely well over the last few days. Okay. Let's keep working here. Okay. As I mentioned earlier, I just want to give you a little bit of a report card. This report card on earnings season is as of the close of business on Friday, January 17th. I will share with you a few earnings reports from today, January 24th, January 21st. Okay. First of all, the earnings scorecard for Q4 2024 as of the end close of business Friday, we only had 9% of S&P 500 companies reporting actual results. So we still got a long way to go with about 80% left, okay? But out of those companies, excuse me, 90%, out of those companies, we have had upside surprise of about 70%. So bottom line revenue, better than expected. I'll unpack that a little bit further here in a second. We have earnings growth that is now expected at 12.5%, which is what I shared for you on the last slide. That is based upon current company earnings as well as forecasts for companies. Okay. We have had a few earnings revisions as of the end of the year, but quite frankly, many companies are expecting higher profits than previously expected, with only a handful of companies reporting that they expect profitability or bottom line revenue to be in line, meaning in line with expectations or a little bit below. In other words, everything's looking very good from a earnings standpoint and the quality of earnings. And I'm going to unpack why that is and what that means. Here's an updated slide for today. So today, you had a number of companies reporting. You had Netflix. Their revenue grew year over year by 16%. They earned over the last 12 months 9.82 billion, 9.82 billion, and they beat estimates by $57 million. GE, or General Electric, they earned close to $10 billion, coming in at 9.84 billion, beating earnings estimates by $461 million. 3M earned $6 billion over the last 12 months, and they beat estimates by $157 million. And United Airlines over the last 12 months earned $14.8 billion, and they beat Q4 estimates by $116 million. Okay. I just gave you Netflix, GE, 3M, and United Airlines for a specific reason. Those companies all kind of exist in different segments and different sectors of our economy, and yet they're all doing fantastically well. They all beat expectations of earnings. The calendar, folks, is packed with earnings coming up. As you can see, tomorrow on the 22nd, we have 63 companies reporting. Some of the larger companies include names like Procter & Gamble, Abbott Laboratories, Johnson & Johnson, Halliburton, Kinder Morgan, Discover Card, Travelers Insurance. On Thursday, we have GE Aerospace, we have American Airlines, to name a few. We have Union Pacific, so on and so forth. And then on Friday, we have Verizon and American Express, and you can see the other names underneath there. Next week's a huge week. We have a lot of tech earnings. Specifically on Wednesday, the 29th, we get Microsoft, we get Facebook, and we get Tesla. And then on Thursday, we get Apple, Visa, and MasterCard. And then on Friday, we get Amazon and Exxon. So we have some major companies coming out reporting their earnings. Now, hold on to what I just said to you about earnings, about who's reporting. It's going to come back into our discussion in a little bit. What I'd like to do now is I want to turn the page and I want to talk about one of my favorite topics, which are the economic indicators, which for those of you who've joined us in the past, you know I love. So let's take a look at some economic indicators. Number one, through 2024, we started to see some small cracks emerging in the economy. Now, when the Federal Reserve raises interest rates, the intention is to create these small cracks. What are they doing when they raise interest rates? Well, what are they doing? They're trying to have inflation come down, but at the same time, they want to have unemployment go up. They want more unemployed people. Okay. And when you have that happen, it does create some cracks. Okay. So as you can see from the table that I'm showing you on the slide, You see GDP growth ease slightly in Q3, and it was forecast to slow even more in Q4, all the way down to 1.7. You can see the unemployment rate. We began the year 2024 at 3.8. You'll notice you saw unemployment start to go up. And as far as our last read is concerned, our last read came in with unemployment at 4.2. You see inflation. Inflation was coming down very nicely. And after coming down, we started to see, excuse me, we started to see inflation sorry about this. We started to see inflation become sticky. The last read, okay, so what you're looking at here when it says Q4 2024, the last read that we received was on January 15th of 2025. It gave us December's inflation. And December's inflation came in at 2.9. Let me show you a better chart on that. Okay. So here's inflation each month, December 2023. Then we got into January of 24. And you'll notice you see inflation coming down. In September, we hit a low of 2.4. And here's what I was trying to say earlier. I apologize. But we started to see inflation start to creep back in, right? Inflation's scary. Why is inflation scary? I'm going to unpack that in a slide in a little bit, okay? If I go back to consumer sentiment is a gauge on how good the consumer feels. You'll notice that in Q1 we had a consumer sentiment reading of 78. Well, look at this. We see consumer sentiment coming down. Our last read was 72. In fact, our last read for the month of December came in at 73 and some change. I'll show you a slide on that in a little bit. Okay. Despite these sloping things that are kind of turning negatively, the good news is that many of the measurements that I'm showing you here remain extremely strong when compared to historical standards. While the pace of inflation has ticked up slightly, it's still historically low. Consumer sentiment, although kind of waning, is also historically high, which I'll show you a slide on in a little bit. In addition to that, Q4 GDP got revised, and as of January 17th, which is when the revision came out, it got revised to say that Q4 GDP actually looks like it'll grow at 3%. By the way, GDP at 3% is where we want to be. It's that Goldilocks scenario, not too hot, not too cold. Again, the Federal Reserve, if they could have it their way, unemployment 4%, inflation 2, GDP at 3. Okay? Um, let's keep working here. So I showed you the inflation side. Let's look at GDP. What I've done here is I've given you how the averages worked out on GDP from 2012 until 2023. I'm going to show you 2024 here in a second on GDP. But before I do, I want to show you the unemployment rate. So from what I was saying earlier, remember the Federal Reserve wants unemployment at 4%. Well, look at this, 2014, unemployment 5.7. Federal Reserve, in doing its job, kind of got to where they wanted to be by 17. We then had unemployment below 4%. Obviously, in 2020, we saw unemployment really spike. 2020 was COVID. In fact, we saw unemployment spike to almost 10%. That 7.7 that I'm showing is just where the averages came out throughout the year. As COVID got put behind us and folks started getting back to work, you saw unemployment come down. And then you saw a labor market that was so darn strong. Look at where unemployment lived through 2022, 2023, and 2024, well below the Federal Reserve's mandate of where they want unemployment to be at 4%. Okay. And I'm telling you all this for a reason. We're going to get to it. If I were to show you this month over month, like I did earlier with some other statistics, if I were to look at the unemployment rate, there's December of 2023. There's the rate. So you'll notice, right? That came in below that 4% level. Well, through 2024, what started to happen is you started to see unemployment go up. For all of you that are listening, you're probably like, unemployment going up, that's got to be horrible for the economy. But think of it like this. The Federal Reserve wants it at 4. One of the reasons why they want it at 4 and not below 4 is because when it's below 4, they find that it causes inflationary pressures. They find that the Goldilocks scenario, again, is unemployment at 4%. And so this was looked at, um, it was looked at positively. It was looked at positively. Hey, we're starting to see unemployment go up. But what kind of happened is as unemployment crossed that 4% level, then people start to get anxious. Oh no, it's going a little bit above. Are we going to skyrocket up to 7, 8, 9, 10%? So on and so forth. And as far as the Fed's soft landing, you can see in July and August, we had readings that came in close to 4.2. So a little bit north just to kind of come back. This is, kind of looked at as the soft landing. If I look at unemployment through 2024, if I average everything out, look at we sat right there, right where the Fed wants it to be. That could be one of the reasons why 2024 was such a great year in the markets, up 23%. But let's keep working here. Let me unpack this. If you think about this for a moment, here what you're looking at was total job openings. So look at this, total job openings. Why were there so many jobs? Think back, look at when this was. This was the end of 2021 into 2022. Do you remember that? You would walk around to places and everybody had help wanted signs inside of their window. They were looking for help. This was us coming out of COVID. Okay. Let me flip over here to quits. So if you notice, since about 2000 until about November of 2024, we had people quitting their job at a huge velocity. And in fact, since the year 2000, we reached one of the highest levels we had in the history of the United States of America. Now, you may think that's funny. Why were people quitting? Well, think about this. Look at how many job openings you had. Look at how many people were quitting. Do you know how many of those folks were folks who were maybe an engineer at ExxonMobil, getting paid $200,000 a year? Phone rings, it's a headhunter. Hello, sir. Would you be willing to move over to ConocoPhillips? ConocoPhillips would like to pay you $250,000 a year simply by moving your desk down the road. Okay. And as those jobs get filled, today you don't see as many help wanted in the windows, right? So as those jobs get filled, naturally, the amount of job openings came down. And naturally, as those jobs got filled, so on and so forth, you saw less and less people quitting their jobs because that phone from the headhunter wasn't ringing as often or with a large enough offer. In addition to that, with so many companies starving for help out there, obviously there was not a lot of layoffs made. Layoffs have been well below the average. And you notice as we get here, layoffs are still very low because the job market is still extremely strong. Although you don't necessarily see those help wanted posters in the windows, you still see them. There's still a lot out there. They're just not, you know, in every storefront. Okay, so we see some cooling in the labor market, but of course, that was the intention of the Fed. The Fed wanted the labor market to cool, and that is happening. Okay, I'm going to switch gears for a second, and I'm going to talk a little bit about inflation. Before I do, I just want to clear the air. When you hear inflation, sometimes it can be confusing. You'll have folks talk about headline inflation and core inflation. What in the world's the difference? Headline inflation is the price of all goods and services, and they're going up or down. And I guess if they're going down, it's not inflation, but if it goes up, it's inflation. Core inflation, which is something the Federal Reserve looks at, strips out food and energy. Why they strip out food and energy is because food and energy are looked at as volatile uh, products and services. And with that volatility, they want to remove it because it can change very quickly. As you'll notice on the chart, the light blue line is showing you headline inflation, while the dark gray line is showing you core inflation. Interestingly enough, if you go back 50 years, their average is identical. Their average is identical. However, if you look at the last read of December 2024, look at core inflation that's at 3.2, and look at headline inflation at 2.9. One of the reasons why headline inflation is below core inflation is simply to do with the price of energy. Energy during the last quarter of the year came way down, as many of you may be aware. Now, as financial advisors, we like to look at headline inflation. Why? Because regardless of the fact that food and energy are volatile, it affects us. In other words, if you're paying more at the pump, if you're paying more at the kitchen table, so on and so forth, you have less money in your pocket to do what? To purchase widgets. And of course, what's every company that trades on the public exchange doing? They're selling a widget of some shape, form, or fashion. Okay. All right. So, headline inflation. As I was saying earlier, June 2020, we hit an inflation rate in the United States of America on headline of 9.1%. You probably all remember this. During 2000, there was no inflation. We started to come out of COVID. When we started to come out of COVID, prices started going up, up, up and away. And this was really scary for the market at 9.1. Why was it really scary for the market? It was really scary for the market because of the fact that, as I mentioned earlier, if you're paying more for everyday goods and services, you have less money to spend on widgets and what companies will be affected by it. And by the way, as you saw inflation going up, up, and away, what did the Federal Reserve do? The Federal Reserve increases the federal funds rate. They pick up their federal funds rate to do what? To cool inflation. Let me throw a little side chart up here. This is the federal funds rate. So this was us going into COVID. The Federal Reserve made a emergency interest rate cut, and then about 2 weeks later, they made another cut. So they went from about 1.75 down to 0.25. And of course, this was us inside of COVID. They held the federal funds rate at that extremely low level for a very long period of time, 0.25. And then they started to increase interest rates, as you can see here. And think about this. Look at where inflation was. This was June of 2022. And the Federal Reserve started to increase interest rates right around that same time as we got these very high inflation numbers. And they brought the federal funds rate from 0.25 all the way up to 5.5. And that happened over the course of about a year and 3 months. It was roughly a 2,100% increase in the federal funds rate. It was one of the most aggressive and it was one of the quickest federal fund rate increases that we've ever seen in the United States of America. But what did they do? If you notice, by increasing the federal funds rate, in other words, the cost of money, they started to crush inflation. And as inflation came down, 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 and inflation kind of continued to come down, what did the Federal Reserve start to do? This whole process took place over a 4 year period of time, but after 4 years without any federal fund decreases, as I mentioned earlier in the presentation, the Federal Reserve in September finally made their first interest rate cut of 50 basis points, bringing that federal funds rate from 5.5 all the way down to 5%, and then continued to make cuts, as you can see here. Now, one thing is, right, is they were doing a good job, but we're starting to see inflation come back. Now, one thing that I always say is is inflation really that bad? And everyone goes, oh, yeah, of course it is. Prices go up. And I say to you, well, what if your wages went up? What if your wages went up? In other words, if you have inflation at 5% and you got a raise at work of only 2%, you did lose money in your pocket. In real terms, you lost 3%. However, what if inflation went up by 4%, but you got a raise at work at 5%? Well, inflation didn't affect you. In fact, you were net net positive in your wallet. So let's flip really quick and let's take a look at wage growth. What you're looking at here is you're looking at wage growth from January of 2000, okay, um, 2020 to our current read. And so, believe it or not, if you kind of think about this chart, look at wage growth, right? That was COVID. So you had unemployment spike up. Obviously, wage growth went way down. Businesses then opened back up quickly. And as those businesses opened up, you started to see wage growth kind of take off. And in fact, April of 2021, you saw year over year wage growth at 15.4%, one of the highest reads we've ever received. And why is that? Think about that with me for a minute. Remember all those help wanted signs? Hey, we'll pay you $15 an hour. Nobody's applying. We'll pay you $20 an hour. That's why you got such a huge wage growth number. As those jobs got filled with folks, okay, what did you see? You saw wage growth start to come down. And as of November 2024, if you look at it from November of 2023 to November 2024, you had wage growth come in at 5.8%. Let's keep unpacking wage growth. And now let's add in inflation. So if you think about it, I went back to 2021. I looked at what the average inflation rate was. I then looked at what the wage growth was. 2022, 2023, 2024. I'll do the math for you. Did the American worker get a raise? Did they get a cut in pay? And the answer is shown here in the form of delta. So obviously, 2021 inflation rate on average 4.7, wage growth on average 9. Average American worker got a raise of 4%. 2022, you can see the average American worker took a wage cut. 2023, and then 2024. You want to see something interesting? Why am I sharing all this data with you? Well, if you start to look at all these pieces of data and then you start to mesh them together, things start to form. Let's take a peek. There's the S&P 500's performance for each one of those years. It is of no surprise to me that in 2021 you had a great year inside of the markets. Why? Look at that big delta of 4%. S&P 500 up close to 27%. It is of no surprise to me that in 2022 you had a negative market. Why? American worker took a cut in pay. And when the American worker takes a cut in pay, what can't companies do? They're not going to sell as many widgets. It's really just that easy. And in 2024, we saw inflation come down. We also saw wage growth kind of subsiding, but you still had a nice positive delta and therefore positive markets. Okay. Let's move on. Let's look at consumer sentiment. What is consumer sentiment? The University of Michigan makes phone calls out to families and asks such questions like, how do you feel about the economy? Do you plan on taking a vacation over the next 12 months? Do you plan on buying a new vehicle? So on and so forth. If I go back to 1971 until current date, the average consumer confidence reading comes in at 84. What this chart is doing via these blue dots that you see is it's mapping out when consumer confidence came in above or below the averages. It's kind of picking out the peaks and the valleys for you. In other words, in August of 2024, consumer sentiment came in, we're going to call that about a 98. That's a very high consumer confidence reading. Contrary, if you look at February of 1975, consumer confidence came in, we'll call that a 58, well below the average of 84. Now, what you may be wondering is what is that number underneath? In other words, what's that negative 6.2? What's that negative positive 22.2? What that is it's what the S&P's performance was over the next 12 months. In other words, from February 1975 to February 1976, the S&P 500 earned 22%. From May 1980 to May 1981, S&P 500 did 20% rate of return. October 1990 to October 1991, S&P 500 did 29%. Interestingly enough, when we have very low consumer confidence numbers, by the way, this makes no sense, right? What do you mean, Derek? What you just said that the University of Michigan asked people, this makes no sense, right? You would think when you got a very high consumer sentiment reading, look at that, January of the year 2000, look how high that can, everyone they called said, I feel great about the economy. I'm going to take 5 vacations, right? What the S&P 500 did, right? And so it's just interesting. This is real data. By the way, our last consumer confidence reading, which was in January for January of 2025, it came in at 73. It came in at 73. Now, 73 is below the average of 84. And remember earlier, I said it has gone down a little bit because our reading prior to that was up much higher at a 78. Okay. So I don't know, obviously, what the market's going to do from January of 25 to January of 26. But if history tells us anything, and I put together the pieces of the puzzle, could it be that a low consumer confidence reading, like we had in April of 2020, results in a market that's hugely positive? Not core data here, but interesting data, especially when I go back to 1970. Okay. We're going to unpack that stuff a little bit more. Don't worry. I'm going to make some recommendations or some predictions. So where are we today? As I mentioned at the beginning of this presentation, whenever I answer where are we today, I always like to look at where we were, where we are, and where we're going. So for those of you who join these webinars regularly, you'll remember this stuff. We show you these speedometers. These speedometers are shown in green, yellow, and red. Just like our traffic light, green is positive, yellow is cautionary, and red is negative. This is what our speedometers looked like back in 2023. I'll give you a moment to kind of study those things. You'll notice there is nothing green. There's a lot of red. There's a lot of yellow as cautionary. If I go 1 year later, for the beginning of 2024, you don't see nearly as much red. You see a lot more yellow. But more importantly, what you also see is you see a lot of those yellow areas getting to the green. They're moving to the green. Look at our speedometers today. Our speedometers today, you see a lot of green. You see very little red. And in addition, the ones that you do see in yellow are moving towards the green. Think about it. Let's just talk about it. Monetary policy. You have a Fed currently today that is lowering interest rates. Okay. And looks like they're going to pull off this soft landing. In addition to that, they're getting very close to their dual mandate. Inflation 4, excuse me, unemployment 4, inflation 2. Look at consumer sentiment. It's not way down in the dumps. It's not well above it. It's kind of right there in the average. That's something we'd want to see. Think about consumer spending. I just got through telling you our wage growth year over year come in about 5.8, 5.9. Inflation today, 2.9. In other words, that is why the consumer's out there spending. The labor market, there's plenty of jobs opening. Again, we're right around that 4% targeted rate. The labor market's very strong. Corporate profit growth in green. You know, the next 2 weeks are going to be very telling. In other words, is this speedometer going to get even more green? I hope so. Inflation cooling. Look at that inflation speedometer. Okay. So I also want to tell you this. When we take those speedometers and we combine them all together, excuse me, sorry about that. We come into what we refer to as LEI, or leading economic index. It takes into consideration all of those things that I just mentioned. And it also bakes in a few other points. It looks at stock pricing, it looks at manufacturing orders. It tries to give us a clearer indication of mixing everything together and then predicting what may happen in the market. This slide that you're looking at, that blue line, think of that speedometer. If the blue line's moving up, it's in the green. If that blue line's kind of flat, it's in the yellow. And as that blue line starts to move in a downward direction, it gets red. These gray bars are recessionary periods. So think about it. This was the dot-com bubble burst. This was the '08 global financial crisis. This was the very short recession that we had back during COVID. And interestingly enough, look what happened here. This was like 2003, 2004. There was no recession, but look at the indicator. It was coming down. This is one of the reasons why many Wall Street pundits, so on and so forth, believe that 2024, maybe even 2023, were going to be nasty years inside of the stock market, or really just not fantastic years. One thing that I do want to draw your attention to, if I were to zoom in for a second, is look at the tail end of this pointing in an upward direction. Look at the tail end pointing in an upward direction. Okay, right there. Because that is pointing in an upward direction, and I did say I'd make some predictions about the 2025 stock market. Obviously, these types of economic indicators, they're not, nothing can predict the future. It's impossible to do, right? But what it does do, and by the way, this indicator has correctly anticipated 3 of those recessions. As you notice, look at the line start to come down. There we go. There's the dot-com bubble burst. This was as we went into 2008, and that's when we went into COVID. This one, it just did not predict. There was no recession there, okay? Even though those economic indicators started to point in negative direction. They're not perfect. They're just simply a piece of the puzzle, okay? So, as we get into 2025, one question you must ask yourself is what are some potential headwinds? Well, as I already mentioned, the resurgence of inflation, equity valuations, which we're going to talk about in a minute, labor market weakness, recessionary pressures, geopolitical tensions. Let's unpack some of them. I showed you this earlier. So we saw inflation go way up. That was into 2022, just to see inflation come way down with the Federal Reserve increasing interest rates. And we've kind of slowly been coming down. But as I mentioned earlier, and as you can see here, are we seeing that resurgence of inflation? Hopefully not, but you see the graph painting a different story. Next, PE ratios. Are we over our skis? What do I mean by PE ratios? Earlier, I said to you, if we owned a privately held company and we had that $1 million come in and we were left with bottom line revenue of $100,000, we would sell our business on average for 3 to 5 times, so $300,000 to $500,000. If we were publicly traded, that same business that we had that bottom line of $100,000 that we would have sold for 3 to 500,000, historically speaking, if we were publicly traded, what we would have fetched is 1,690,000 for our company. PE ratio stands for price of the company divided by its earnings. Publicly traded companies, S&P 500 companies, over the last 30 years carry an average PE, price to earnings ratio of 16.9. Wait a minute, Derek. You mean to tell me if you owned a company that had bottom line revenue of 100 grand and it was privately held, meaning it wasn't publicly traded, it would only be worth 300 to 500,000. Yet, if that company was publicly traded, it is now worth $1,690,000 on average. Is that what you're telling me, Derek? Yes, that is what I am telling you. How can that be? Well, it's because publicly traded companies are liquid. You can sell them with the click of a button. So that 12% difference between privately held and publicly held is what's referred to as the liquidity premium. As of January 16th, so last Thursday, PE ratios of S&P 500 companies were at 21%, far above their 30-year average of 16.9. Point being is, are we a bit over our skis? What I always say, and for those of you who joined webinars previously, everything reverts to the mean. Everything reverts to the mean. You take a rubber band, pull it as far as you can, let go of it, it reverts to the mean. And so don't averages. And so what needs to happen in order for us to get back to the mean? One of two things or a combination of the two. Stock prices need to come down in price to come back to the mean, or earnings need to go up. Okay. So remember, we just entered earnings season. Earnings season looks like it's going to be terrific. And so, do earnings go up and therefore we work our way into that P ratio, or do stock prices come down? Obviously, as I mentioned to you earlier, we have a wave of earnings coming up ahead of us, and it's going to be a look and see. Expectations are that earnings will look beautiful. Why? And now I'm taking all of these bullet points and I'm going to start piece together puzzle for you. Well, the unemployment. Unemployment is looks great. We're so strong. Okay, the backdrop of the economy is so darn strong today. Everybody's working. Our average unemployment rate through 2024 was 3.7%. The unemployment rate number that we um, just received, or we got 2 weeks ago. We came in at unemployment at 4.1. By the way, the month previous to that, it was 4.2. We came down to 4.1. Think about this for a second. 4.2, we came down to 4.1. When did we get that number? 2 Fridays ago. 2 Fridays ago, the stock market, the Dow Jones Industrial was down 700 points. Wait a minute. It was down 700 points, yet you had unemployment go from 4.2 down to 4.1. Isn't that good? More people are working. There's more people working, and unemployment 4.2 came down to 4.1. Yes, but but does that mean that the Federal Reserve keeps interest rates higher for longer, or in fact, maybe even looks to push up interest rates? Remember, we have inflation going up. You saw that in my previous graph. And you have unemployment that, the Federal Reserve would have liked, even though they have the mandate at 4, and it went from 4.2 down to 4.1. Yes. But, the question is what will happen with rates? But you have this incredibly strong labor market. And when you have a whole bunch of people working and a whole bunch of people experiencing that wage growth and inflation being pretty tame, what do you have? You have companies selling more widgets, and therefore companies are earning more profits. Um, Back to my softening thing, what I did say is, listen, that's all happening. You still have a lot of job openings. That is driving some wage growth. You don't have as many people quitting, as I mentioned earlier. That is softening wage growth. And companies, though, still starving for workers, are no place near their average of layoffs. So you have that occurred. Potential tailwinds. Artificial intelligence, monetary easing, and improving corporate profits. Let me take a sip of water here. Okay, so 1950 to 1960, if you think about it, during the 50s, what did you have? You had significant market growth. It was fueled by post World War II economic recovery and consumerism. You had all these GIs coming back with the GI Bill, millions of Americans buying home, pursuing higher education, investing in the economy. You had advances in manufacturing, particularly in automobiles and consumer goods. Think about it. All these GIs coming back. They wanted a house. They wanted this thing called a TV, a refrigerator, et cetera, et cetera. You had huge amounts of economic expansion. When you got into the 60s, you also had technological innovations, cultural transformations, and these things really started to contribute to market growth, not to mention the space race that we endured, which spurred tons of aerospace investment, tons of electronic industries, companies like IBM, New Computers, System 360, revolutionizing business processes. You had the civil rights moving, you expanded middle class, increased workforce and consumption. The Kennedy administration cut tax rates. You had a whole bunch of public infrastructure going into place to kind of help with what happened during the 50s, and the economy really during the 60s did really well. Then we got into the 70s. The 70s I like to refer to as the hangover from the 50s and 60s, right? You had 20 long years of economic expansion. And then all of a sudden you got into the 70s and it was the hangover. Now, as we all know, during the 70s, we experienced stagnation. We had the oil crisis. We had high inflation and high unemployment. Okay. Um, but then we got into the 80s. You had the Reagan boom and you had globalization. And so when the 80s when you kind of got into the 80s, what you had the Reagan administration come in. They cut tax rates. They deregulated a whole bunch of stuff. They reduced government spending. Uh, Technology that kind of came out in the 60s. There was huge advancements that went on top of that, such as mobile phones, fax machines, so on and so forth. You also had NAFTA and the whole globalization, and you had a spark in the economy. Now, again, at the beginning of this presentation, I said it's not a political discussion. But one thing that the Reagan administration did do and could control, because believe it or not, the White House really doesn't have much control over the economy. They can put in policies and procedures that may affect the economy down the road, but directly, especially in the short term, they have very little influence over what happens with stock prices or what happens with the economy. However, there are two levers that they can pull, not just the White House, but Washington in total. And that is tax rates, and regulation. Now, because this isn't a political discussion, You may think, hey, if you have tax cuts, if you have deregulation, those chickens come home to roost, and there'll be a price to pay for that down the road. And you very well may be right, but that isn't the discussion that we're having. We're having a discussion about markets. Stock market isn't looking down the road of those chickens coming home to roost. The stock market is looking at profitability quarter over quarter. And so if you think about it today, if you look at all of the bills that you have, I'm willing to bet that if it is not the top expense you have, it is the top three expenses that you have, and that would be taxes. Immediately, if you cut the tax rate, bottom line revenue goes up, and therefore stock prices go up. Deregulation. You work at a company, and that company has to deal with any type of regulation, that regulation costs money. If you have deregulation of that regulation, therefore it costs less or it disappears, bottom line revenues go up, stock prices also go up. Reagan did a lot of that stuff. I explained it a bit in depth because of where we are today. But from the 80s to the 90s, you had the Reagan boom, globalization. Then you had the 90s to the 2000s. And of course, that's when I was first getting into the business. The dot-com bubble burst. You had massive amounts of investing inside of new business models. You had computing, all the telecommunications, text messages, these types of things all came into play in the 90s, and it really revolutionized business. Back to that little boutique shop that you and I own, someplace in Denver, made $1,900,000 in expenses, $100,000 bottom line revenue. Well, all of a sudden, let's say we own that particular business, through the 70s and the 80s, and now the 90s came around. And let's pretend that business was, I don't know, a dog food store. Well, who was our potential customer? The local community. The local community was our potential customer. All of a sudden, in the 90s, who was our potential customer? The world. We could have a website and we could now sell our product to the world. And that's was crazy. So the 80s and the 90s, so on and so forth, just like the 50s into the 60s, huge amounts of growth, huge amounts of catalyst for the market. And then very similar to the 70s, we got into the 2000s. And the 2000s, I like to refer to as the hangover from the 80s and the 90s. And as you know, the 2000s began with the dot-com bubble burst. That was followed by the September 11th attacks. You then had 2008, which is the global financial crisis. So really, the 2000 to 2010, think about it. You had two major recessions in there. You had an enormous terrorist attack on American soil. We refer to it in my business as the lost decade. There was really no progress, at least from the stock market's concern, during 2000 to 2010. And then you had from 2010 to 2020, very similar, right? As we came out of other recessions, it kind of started with some little green shoots. Okay, we had the digital revolution. We saw huge amounts of expansion and digital transformation. You had social media platforms pop up, cloud computing. You started to finally see that e-commerce really take hold and giants expand like Amazon and Alibaba. You started to see those e-commerce businesses really become global e-commerce businesses. You started to see the advancement of smartphones, artificial intelligence, new industries and opportunities popped up, clean energy, electronic vehicles, biotechnology, so on and so forth. And here we are, and it's 2005. And one thing that I was always looking for is what's a catalyst to shoot us in or continue huge amounts of economic growth for the next 15 years. And maybe we found that. And when I say maybe we found that in artificial intelligence. Artificial intelligence is amazing. We use it inside of Triumph Capital today, but to see it being used by companies all over and to hear the phrase artificial intelligence inside of earning calls, so on and so forth, it is enormous. What will it be a catalyst for? Well, just think of the catalyst that it can have. Everything from our electrical grid to advanced machine learning to figuring out logistics, helping calm down that inflation. You can see artificial intelligence putting its tentacles into every sector of our economy and making it better, making improvements, just like we had in the 60s, making improvements on all of the technology that we have today. No different than in the 60s, how all of that technology was better improved on from the 50s. And I think it's here, and I think it's really unbelievable. And I think it will be a huge market catalyst as we move on over the next 5 to 15 years. Let's keep working here. As far as valuation metrics, I talked about PE ratios earlier, and I made a comment that you might not like. And that comment might have been, do we have stock prices come down or do we have earnings go up? So let me just be clear. What do we believe? We believe that earnings will go up. In fact, today, this was earnings from 121. As I mentioned to you earlier, Netflix, GE, so on and so forth, 3M, all crushing earnings, as you can see here. Okay? So, 2025, we're coming to an end here. These these are some forward-looking statements. We believe that corporate earnings will continue to do extremely well. We believe that they will do extremely well for a number of factors. Those factors I've shared with you this evening, but those factors include corporate tax rate cuts that immediately adds corporate profits, deregulations in different industries that immediately adds to profits of companies, the labor force being so darn strong. In other words, our employment, the Federal Reserve getting that soft landing, so on and so forth, and artificial intelligence being adopted by more and more companies, therefore making them more efficient, more effective, and therefore boosting their bottom line profitability. One thing that I am worried about is I am worried about inflation and interest rates. One cloud that I see happening in 2025 is simply this. Because I think corporate profits will be so darn great, everything's a double-edged sword. I think the unemployment rate, especially with companies increasing bottom lines, having cut in pay, being influenced to produce more things here locally or in the United States, I guess I should say, um, creates unemployment coming down, which is inflationary. So I'm a little bit worried about inflation. I'm a little bit worried about inflation, which in and of itself makes me a little bit worried about interest rates. I think, and I guess I'm going to flip this slide for a second, this chart's offered by the Federal Reserve. FOMC stands for the Federal Reserve. And if you notice here, their own graph, they show themselves cutting the federal funds rate in the coming quarters and years, finally to their long-term federal funds rate target of 3%. However, I just simply don't see this happening. I think inflationary pressures, because of how strong the economy will be, because you'll have unemployment not hang around that 4.1, it'll continue to come down. And because you'll have such a strong labor market behind this, which is inflationary, I think the Federal Reserve is going to have to keep the federal funds rate steady Eddie, and in fact, perhaps increase it in time. This December, when they cut 25 basis points, I don't think they wanted to cut rates. Think about it. Today, you have inflation at 2.9. That's very close to their target of 2%. And you have unemployment at 4.1, 4.2. That's north. Now, when you cut interest rates, what does that do? What is that intended to do? When you cut interest rates, the net effect of it is that you have unemployment come down. And remember, the Fed wanted unemployment to go up, not come down, because we were well below the 4% target. And in addition to that, when you cut interest rate, it causes inflation to go up. And remember, we're at 2.9 today. We're not at 2. It's not like we're at 1.9. They don't want to see it go from 2.9 to 3.2. They want it to come down to 2. They've been cutting rates because, yes, I understand housing and 30-year mortgage rates and all of that great stuff. But at the end of the day, at the end of the day, the Federal Reserve has that dual mandate and they will stick to it. That being said, we do have a federal funds meeting coming up 28th and 29th of January, I believe, and we will get a federal funds interest rate policy decision. I kind of lean towards that they may cut in January, okay, after their meeting, but I don't think they should. I don't think they should have cut in December. I think the fact that the market really wants them to cut some more is going to be a little bit of a cloud that hangs over the market. That being said, I am not afraid of that. Why am I not afraid of that? The Fed cuts interest rates in the face of a weak economy. Okay, they cut interest rates in the face of a weak economy. They raise interest rates or keep interest rates flat in the face of a strong, robust economy. So, although this may have short term fluctuations and cause the market to be volatile, I think what I am painting for you is very strong. And I think I see that through 2025. In fact, here are some of the predictions. I think GDP in large part will stay flat. Again, we like to see it at 3, but I think GDP in large part will stay flat. I think unemployment in large part will stay flat. I think the reason for that, and one of the reasons why I see these staying flat, is because of what I mentioned of the Federal Reserve. Although we may get a cut or two through 2025, we'll see. When we get to the end of 2025, I will remind all of you as we get to 2026. Remember what I said? I didn't believe there'd be interest rate cuts, although there may be one or two. I do think that will kind of be in the steady eddy holding pattern, but corporate profits will continue to grow. Those are what my slides say. I do want to point out one other thing, the pulse of the job market. There's two interesting charts on here. Number one, I did talk about consumer spending. When I say consumer spending, I think I unpacked that by saying to you all about the unemployment rate, people having money in their pockets, so on and so forth. But one thing that I want you to know is as we came out of COVID, people had a lot of savings built up, right? There was a lot of injection of capital into people's pockets, so on and so forth. And a lot of that savings has gone down, as you can see with the blue line. Okay, it's a lot of it's come down. What we're also seeing is we're seeing credit card delinquencies go up. On the surface level, that may seem bad, but let me unpack it for you. Number one, we saw a lot of that savings get spent down, but at the same time, you also see my blue line, which is that liquidity savings starting to come back up. Okay. Well, think about this. People were locked away in their houses for COVID, so on and so forth. They were finally let out of their houses. They wanted to take a vacation. They needed to get some new clothes. They maybe even needed a new computer, a new cell phone, blah, 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 blah. And you had this spending go down. In addition to that, when I say credit card delinquencies going up, two things I think are happening inside of there. Number one, when you had interest rates go up, okay, and even though they've come down in recent months, you had them go up. Think about somebody who has a credit card balance. They used to pay 18%. Minimum payment on their credit card was 200. Now their credit card interest is at like 28. Instead of a $200 payment, they have a $400 minimum payment. Perhaps they had it set up through their bank that they were paying automatically $200 a month, and they simply missed the fact that it's gone up to 400. Some of that's baked in there. In addition to that, you had student loans that were suspended. In other words, folks did not have to pay any payment on their student loans. Do you know how many kids that graduated college over the last years came out with student loans, didn't have to make a payment on it, got their first job, didn't anticipate needing to make that student loan payment? Biden administration, so on and so forth. If you remember, hey, we're going to forgive it, never ended up getting forgotten. And 2 months ago was the first time in 3 years that folks with student loans had to start making payments on it. Well, oh my goodness, I have to make my student loan payment. I haven't budgeted for it. I'm not going to make my credit card payment, or I'm going to make my credit card payment be lower. I do think we'll start to see this purple line flatten out and then go down. And I also think we'll see savings go up. Why do I think that? It boils back to the labor market and it boils back to the unemployment. What's ahead for short-term rates? I kind of already covered that. January 28th, 29th will be the first meeting of the FOMC, the Federal Reserve, for 2025. I think on the 29th, you'll have Federal Reserve Chairman come out and I don't think they should cut rates, but I think they might cut rates 25 basis points just because the market anticipates it. We'll see where the economic data comes in. Remember, these are forecasts. Nobody can predict the future. That being said, on their website, they still show this prediction. So next, here's the forecast for the pundits for 2025. You'll note, if you remember earlier, I said to you that we closed the year on the S&P at 5,881. Here is the group average of where the S&P will close for 2025. By the way, if you do the quick math on that, that means that we would have a rate of return inside of the S&P 500 during 2025 of 12.7%. I think that we will have volatility. Remember to my first graph with those red dots. I believe that volatility will come by the surprise that the Fed will not be cutting at such a velocity that the market believes the Fed will be cutting, and that the Fed may even, because of the strong economy, especially as we get to the end of the year, start to bake into the lexicon perhaps a raise. I know it sounds crazy, but that's what the economic data is saying. What I want everybody to remember is the value of discipline. What this chart's showing to you now is if you go back 96 years, If you go back 96 years and you invested money inside of the S&P 500 on January 1st to December 31st, there was a 73% chance if you invested for 1 year that you made money. What I mean by the value of discipline is, what if that investment time horizon was now 3 years? By holding on for 3 years, if you go back for 96 and you look at every 3-year period of time, 80 to 83, 81 to 84, every 3-year period of time, you just increased your chances of earning money. 84% of the time you made money. You want to hold on for 5 years? 88% of the time you made money. And if you held on for 10 years, 94% of the time you made money. So the value of discipline, the value of education. We're wrapping up here. Steps for you to take. Keep us informed of your important life changes and important financial changes. It's very important for us to know that stuff. We tailor portfolios specifically for you. It's not all about tactical rotation of the market and all the economic data I shared with you. At the end of the day, fundamentally, it plays a lot in how we manage money, but your portfolio should be tailored specifically for you. Tell us and talk to us about your concerns. Typically speaking, when we know about your concern, we can help address it. We can help ease that concern. Make sure your essential documents are up to date, your estate planning documents, so on and so forth. We can help. Steps for us to take. We're always going to keep you informed through regular communication. We're going to manage your investments according to your personalized strategy. We are always going to pay attention to all the economic data. We're on top of it all every single day. Thank you all for joining tonight. Until next time, I'm signing off. Derek Eichenwald, Triumph Capital Management. You have all of the company information, all of my direct information on your screen now if you want to take a minute and jot it down if you don't already have it. And I thank you all for joining tonight. Thank you so much. Have a wonderful night. Happy New Year. And let's get through earnings season. I think earnings season's going to be terrific. Thanks again for joining, and I'll see y'all soon. Bye-bye.